What's up, everybody? According to Goldman Sachs, the ongoing plunge in U.S. home prices may be nearing its end. The sharpest declines in the U.S. housing market are now behind us, Goldman analysts Ronnie Walker and Vinay Viswanathan said in a client note released on Monday. They believe that the U.S. will not have a recession this year, and in fact, we're heading for a soft landing. Specifically, the firm sees a 35% chance of a recession, while the average on Wall Street is much higher, around 65%. The strategists added that they expect a peak-to-trough decline in home prices of roughly 6%, and that they expect home prices to stop declining around mid-year. Now, they do specify that this expectation is not for all housing markets across the country. In fact, they believe that overheated markets on the West Coast and in the Southwest may experience larger declines compared to the national rate. On a regional basis, we project larger declines across the Pacific Coast and Southwest regions, which have seen the largest increases in inventory on average, and more modest declines across the Mid-Atlantic and the Midwest, which have maintained greater affordability over the past couple years. They cite 4 cities: San Jose, California, Austin, Texas, Phoenix, Arizona, and San Diego, California, that they think will see price declines of 25% from recent highs. Those declines would be on par from the collapse experienced during the 2008 housing crash. Last week, Fortune reached out to Ali Wolf, Zonda's chief economist, to get her opinion on whether she thinks that the U.S. housing market recession is actually bottoming out. So let's see what she has to say, and then we'll take a look at this week's data on the housing market. So let's just dive right in. Fortune asked Ali if she also sees signs that housing demand is starting to recover. She responded by saying there has been an uptick in buyer interest since the beginning of the year related to 3 key things: seasonality, acceptance, and discounts. So let's go through them quickly. Seasonality. She points out, and I agree, that the spring market, which usually starts right around the Super Bowl, but can start earlier if the weather is good, is always busier than the end of the year. Zonda reported that 38% of the builders told them that traffic has been stronger than expected in January so far, which shows renewed interest. The more important metric, in my opinion, is to see if resale inventory increases, as it usually does in the spring market. Acceptance. Buyers are entering into the acceptance phase that interest rates are just simply not going to be what they were when they were historically low. We're now in the 10th consecutive week of mortgage rates averaging below 7%. This stability in rates is giving consumers a bit more confidence about where the market is right now. Discounts. Home builders now represent over 30% of overall housing inventory. According to Wolf, roughly 40% of the builders have ripped the Band-Aid off and lowered home prices between 5 and 15%. As a result, for those consumers, the FOBAT, fear of buying at the top mentality, has calmed down a bit. Heading into 2023, Zonda predicted that U.S. home prices would fall around 15% peak to trough. So Fortune asked her if she's made any shifts in her expectations for U.S. home prices. Here's her answer. We still expect home prices to be down in 2023 compared to 2022, but how deep a decline will depend on how quickly sellers find the market with price cuts, what happens with mortgage rates, how inventory levels trend, and what happens related to a U.S. economic recession. According to a NerdWatch survey about the current slowdown, 2/3 of Americans believe that a housing market crash is imminent in the next 3 years. So what do you guys think? Are you part of those 2/3? Do you think a housing market crash is imminent? I can tell you that here where I work in the DC market in Montgomery County, Maryland, and Northern Virginia, if a house is priced right and shows well, it is still selling at or above asking with multiple offers. On the other hand, yesterday I visited 2 houses in Potomac with my buyers that showed terribly and needed a lot of work. They smelled bad, the kitchen and the bathrooms were original, the carpet was disgusting, and they were priced too high for how much work they need. These houses are just sitting on the market, and they're going to continue to sit there until their prices are reduced again and again and again to the point where some buyer is just not going to care. I also have clients that are interested in new construction here in Bethesda, Maryland, and I can tell you that activity has definitely picked up. In the last week, all of the home sites in the first phase have either been put under contract or have a hold on them. And this is good for the housing market, showing a renewed interest and activity, but it's bad if buyers have an expectation that prices are going to go down. Let's end with some current data from Redfin to see how the housing market is faring overall. For the week ending January 26th, 30-year mortgage rates dropped to 6.13%. The daily average was 6.18% on January 25th. Mortgage purchase applications during the week ending January 20th increased 3% from a week earlier and 28% from the early November trough, seasonally adjusted. Purchase applications were down 39% from a year earlier. Google searches for homes for sale were up about 40% from their November low during the week ending January 21st, but down 21% from a year earlier. New listings of homes for sale fell 18.3% year over year, the smallest decline in nearly 3 months. Active listings, the number of homes for sale at any point during the period, were up 23.6% from a year earlier. Pending sales were down 26.2% year over year, the smallest decline in over 3 months. Homes that sold were on the market for a median of 47 days. That's up from 32 days a week earlier and the record low of 18 days set in May. On average, 5% of the homes for sale each week had a price drop, up from 2.1% a year earlier. The average sale to list price ratio, which measures how close homes are selling to their final asking price, fell to 97.8% from 100.1% a year earlier. This is the lowest level since March of 2020. So what this all tells me is that buyer activity is definitely up, and this could be a direct result of mortgage rates going down a little bit and the spring season upon us, but it's a good thing for the housing market. It also tells me that houses are still taking a lot longer to sell than they used to, which could create a more balanced market. In any event, I think the next couple weeks and definitely the next couple months, it's going to tell us a lot of information about this year's housing market. I really try to bring you guys the most up-to-date information so you can make the best decisions for you and your family. If you did get some value out of today's video and you want to show our channel some support, definitely smash that like button, comment below, and consider subscribing to our channel. It just motivates us to make more videos. Thanks for watching. I do appreciate it. Bye!